Well, hi there. Americans looking for their forever home may have a difficult time right now as the market is way out of hand. Rising interest rates and a dismal home affordability index are just the cherry on top. So if you're considering buying a home, you might want to pause and rethink your strategy. This situation closely resembles the 1980s when interest rates skyrocketed and made affording a house almost impossible. In this video, we'll discuss how history might be repeating itself today in 2023 and how it may affect prospective homebuyers. The American housing sector is going through a major crisis as we speak. Prices are way too high and out of the affordable zone. Home prices nationwide have skyrocketed, making potential homeowners feel helpless. This trend has been particularly acute in recent years, with many homes selling for much more than they're worth. Millennials who are coming of age and need to buy homes for themselves are in for a difficult house market. Let's say it's the worst time in a generation to buy a home. Why do we say that? Well, the 1980s saw a similar situation when the HAI, or Housing Affordability Index, declined, much like what's happening now. The Housing Affordability Index is a measure that helps determine the accessibility of housing to different income groups. This index is calculated by considering various factors such as median income, median home price, and mortgage interest rates. A high index value indicates that a larger share of households can afford to purchase a home, while a low index value means that fewer households have the financial means to buy a home. It's crucial that the HAI remains high for the good health of the housing market. A 100% or higher percentage means that housing is affordable for everybody, and fewer than 100 means some people can't. Looking at it can give valuable insights into the state of the economy and the overall living conditions of a region. Here you can see how the index has dropped from being at 160 in 2019, then 142 in December of 2021, to 91 last October. It has slightly gone up from there, but only slightly. With interest on the rise, it will only drop further down the line. In 1971, house affordability was very high, almost 150%. Then came the downfall, where the economy got worse and decreased the HAI, the 80s. And if you're enjoying this channel, please hit that like button and subscribe to our channel for more such videos. Now, let's continue. The 1980s was a challenging time for the U.S. economy as it faced multiple economic problems that impacted the housing market. The decade began with a severe recession, which was the worst since the Great Depression, resulting in high levels of unemployment and inflation. The interest rates in the 80s went in double digits. On average, it was 5.42% from 1971 to 2023. But the highest average annual interest rate that the U.S. has experienced is 20.61%. This was in March of 1980. It was an extraordinary moment in the country's economic history, and it had significant consequences for businesses and individuals alike. This high interest rate made it extremely difficult for people to borrow money for investments, such as homes or businesses, and it made the cost of borrowing too high. Even the inflation rate was at 14%. Additionally, the decade saw a shift in the job market, with many manufacturing jobs moving overseas, leading to a decline in the number of well-paying jobs for working-class Americans. This trend, coupled with the high interest rates, made it difficult for people to save for a down payment, worsening the affordability problem. The high interest rate also led to a steep decline in the stock market as investors lost confidence in the economy's ability to sustain growth. Home buyers were in shock because the previous year, in 1979, home prices grew 14% nationally, while some markets even grew 20%. The sellers made hefty profits in that era by selling houses that weren't even worth the price they were sold at. Mortgage rates went up 15%, which meant so many people were rendered helpless because they simply couldn't afford the payments. But what happened in the 70s to cause the massive economic downfall in the 80s? In 1971, the U.S. had an unemployment rate of 6.1% and inflation of 5.84%. Now, to combat this situation, President Richard Nixon took a number of steps, famously known as the Nixon Shock. He directed the breakup of the Bretton Woods Agreement, which was a deal made in 1944 between 44 countries, including the United States and many European nations, to create a system for managing international money exchange. It made the dollar the main currency used for international trade, while other international currencies were pegged to the US dollar. But let's not jump into further details of that. Nixon ordered the breaking of this agreement by announcing the closing of the gold window, which meant that foreign governments could no longer exchange their U.S. dollars for gold. Before that, the dollar was backed by gold, which means that anyone holding US dollars could exchange them for a fixed amount of gold. He did this to stop the devaluation of the dollar and encourage Americans to buy American products. This action is widely considered a political success, but a failed one if we talk about the economy. It caused the 1973 to 1975 recession. Now the dollar was no longer tied to a fixed value in gold, and the constraint on the money supply was lifted, which meant that the Federal Reserve could easily increase the money supply. This action caused the currency to plunge further and a rise in inflation. As a result, the Fed increased interest rates to bring inflation down, making house mortgage rates unbelievably high. It's all interconnected. This clearly indicates how crucial interest rates are for the housing market and how a rise in the rate can affect the overall HAI of the whole market, causing it to tumble. So we can say that the 80s recession was the correction needed to bring down the unstable prices and market, and in 1986, HAI was back at 100% again. Does this situation look something familiar? Well, today we're seeing a comparable housing market situation. Right now, the average interest rate for a 30-year fixed mortgage is 6.95%, which is almost considered a good rate. But is a favorable interest rate the only thing to look at while considering buying a house? The answer is no. Are the house prices even in the affordable zone right now? See for yourself. This data shows the median house price of existing homes in the country. If a house cost $252,000 in 2017, the price went up to $380,300 in December last year. But during the second quarter of 2022, we saw the highest point of this chart, an astounding $405,900. We know how the Fed has been increasing interest rates continuously as an effort to fight off inflation, and mortgage rates have been increasing as a result. This means that if you were to buy a $400,000 house today, with the current interest rate, you would have to pay $800 on average per month more than what you would have to pay if you bought it a year ago. But have there been any increments in incomes? Well, no. Last year, wages and salaries increased by 5.1%, which isn't enough for people to maintain a balance between mortgage payments and other expenses. Let's take a look again at HAI. One thing that this index doesn't take into account is the down payment. It only reflects how many people can afford a median-sized home and pay the mortgage, considering that the buyer has already put down 20% of the home's value. In today's market, that amounts to a staggering $60,000 to $80,000, excluding additional expenses like closing costs and lender fees. This poses a significant challenge for many Americans, as even if they can afford the monthly mortgage payments, they might not have enough cash on hand to make the down payment. This hurdle makes it difficult for many people to enter the housing market and become homeowners. Consequently, the House Affordability Index alone can be misleading as it fails to consider this crucial factor. A more comprehensive assessment of housing affordability would need to take into account the down payment, along with other factors such as income, credit score, and debt-to-income ratio, to provide a realistic picture of the housing market's accessibility. The HAI of the last quarter of 2022 was at 95.5, which needs to go up. So to bring back the stability in the housing market and bring HAI to a more stable state, should history repeat itself? It will take a few more years to calm the situation and bring about much-needed correction, but only time will tell what lies ahead. If you like this video, we're sure you'll also like other informative videos on our channel, so do check them out. Please hit that like button if you haven't already and subscribe to our channel for more amazing content. In the end, thanks for watching.